Listen, guys, if you own your own business and the building it operates from, there's a tax selection many owners miss, and it costs them. It's called the grouping election. Here's the setup. You keep your real estate in a separate business entity like an LLC, and your business pays rent to that LLC. To the IRS, that rental real estate is a passive activity. So when the LLC's expenses exceed the rent it collects, you end up with a passive loss. And passive losses can only offset passive income, not your active business income. So the losses sit suspended until you sell the property or rack up enough rental income to use them. And that could take years. But here's the fix. The IRS lets you group your business and real estate as one activity if they form what's called an appropriate economic unit. For example, a doctor who owns his own practice and the building it sits in has a strong case. Group them, and those trapped real estate losses become active, offsetting your business income. Here's the catch, though. You have to actually make the election. That means attaching a grouping disclosure to your return, which lists the activity, its address, and EIN, the year your building goes into service. Once it's made, it's very hard to undo, and this is what lets you fully leverage a cost segregation study. Without grouping, all that accelerated depreciation just becomes more passive losses you can't use. Now, if your CPA didn't tell you this, follow and I'll tell you the next one.